Hello everyone. Today's video is going to be a look at different types of risks associated to individual names, and for the purposes of this video I'm going to be using uh, anonymous companies that are based on the profile of junior uranium stocks to look at individual cases, what a company has going for and against it in whatever case they find themselves. Okay, so company A is going to be a fantastic high-grade deposit in Saskatchewan, Canada, also known as the Athabasca Basin. Also, it's fairly shallow, high grade, as I said, and part of it is under a lake. In addition, it is already partially foreign owned. Company B is going to be a big, defined deposit, almost ready for construction in Namibia. It's higher cost though. Company C is a big high-grade ISR project in the US. Unfortunately, it's on some disputed land, and it also has another project that is slightly higher cost and for the meantime less exciting. Um, Company D has a portfolio of projects across Africa, and Company E has cash flow from another commodity, and it's a higher grade deposit, but it is in Niger. I want to start this by saying Canada is great for a lot of things. It's peaceful, stable, and add to that a great deposit. It's great once you can go into production. For that, they're the same great things will end up slowing down the permitting and may include people who are not reliant on the project going into production or in order to advance the local community, and who may not be in favor of some eco damage in so that you can make your money. Also, while I'm sure that many will be looking for high grade deposit to buy out at the peak of the cycle, it's worth thinking about that who may be allowed to buy out the deposit, because I'm not sure if China would be able to buy up a controlling stake and take control of a deposit in Canada. Now, that may mean that for a deposit like this, the biggest suitor is basically already out of the question. Okay, so when it comes to uranium mining, I think Namibia is a fantastic location, personally. But I can understand if some people might be biased against it for some reason of association or some rational thought. Now, the problem with Company B, which is a higher cost large deposit in Namibia, would be the higher cost aspect, meaning the not only can the back half of a cycle be very concerning and vicious, but you are also at the back of the line if the ramp up is slowly, and meaning that anything speeding up or having lower costs than expected could make the deposit less valuable. Anything that shortens the cycle or tames the price move hurts you most. Company C, that high grade ISR in the good old US of A. Well, this is another example of first world problems. If things get resolved and this ISR project is able to go into production and everything goes well, then that's fantastic. This company will do fantastic. However, it you also should probably account for the possibility that if uranium goes to $200 and your project is stuck in court, you will be losing your mind wanting to yell at judges and lawyers for all the good that that's worth, and it still may not go into production. Company D is that portfolio of African projects with a very enthusiastic set of shareholders. Now, I've been over the cost structure of this type of thing in a previous video, and people don't like that I call it high cost. Well, I just use the numbers in the technical reports and a slight judgment on my part, but that doesn't matter because if you believe that uranium's going above 70, maybe 100, maybe 150, maybe higher, you don't want to be buying low-cost deposits at this point. It's not the way to play it if that is your belief. Now, diversification in one company is a good thing. Its locations, well, let's say you have access to a possible Chinese buyer and you also get short permitting. So that should be helpful. Now, trying to jump the cycle, if they try to finance before the price target, well, the analogy I would use is trying to make a car faster by stripping out everything, including the seatbelt and brakes. That could work. I suppose that is one way of doing it, but may not be the best way, but we'll see. Could be. Now, if you understand for this company that between 25 and 50, the company's probably technically not worth anything, you should understand that if it goes from 70 to 120, you're probably basically going to be needing a bigger bank account. Now, company E is the cash flow from another commodity plus a deposit in Niger. Now, I'm not an expert on the tax code of Niger, but I did read up a little bit for the research in uranium stocks. This affects company D as well, but I suggest reading through as a refresher the tax information for Niger, which states that the state or a state-backed company has the right to buy an additional 30% of a project in addition to the 10% carried interest at fair market prices. I don't know who determines the fair market prices, but it's just something to read up on. So as for the valuation of this thing, more commodities means more valuation factors. Now, this company doesn't say exactly what their costs are for the other commodity, but it can be worked out to be found that it's not a marginal cost of, it won't be shut down. Now, this may mean that the project can be completely financed with existing cash flow, and they won't need to issue large amounts of equity and finance with debt. Now, also, the higher grade of this project may mean that if the cycle is slower and if they're able to execute, they can go into production without needing very high prices. But they would still be able to participate in the ride up if the prices keep going higher. Now, please understand, the point of this video is not for me to be telling you what I think is wrong with your favorite uranium stock. It's about me just trying to look at a bunch of ways of examining a company within the portfolio and seeing some risk, and in the process, hoping that you understand or I make it abundantly clear why I believe having a portfolio of projects is important. Now that's it for today. I hope this video helped you think about different types of risk and reward and how you want to position yourself for the uranium cycle. Now, I hope that you understand why I view diversification within the sector as vital. And lastly, I'm going to leave this with you. I'm interested in knowing which of the risk-reward setups that I outlined in this sounds the best to you. And I invite you to tell me in the comments and be kind with me not having any idea because I said something or didn't. And with that, I will say thank you for watching. I hope you enjoyed and catch you next time. Hey everyone, just quickly, you can read this here or in the description of any video. Just remember, what I do and say here is meant to be a helpful supplement or thought filter for your research, not a replacement for it. I can be wrong, and I'm often quite early, aka wrong for a good while, which is why none of this is ever investment advice.